Good afternoon, everyone. Great to be with you again. Brad Macbeth here with the Simple Plan Live. Today, we're going to be looking at our second in the series on guaranteed income in retirement. Today, we're looking at annuities. We looked last week at guaranteed monthly withdrawal benefit programs. And so now, we're going to look at another stalwart. Been around for a long time, not very sexy, but something very timely for the circumstances we find ourselves in. It's based on this premise that we want to have guaranteed streams of retirement income in retirement because we're very accustomed to having regular income. When we work, we have paychecks. Well, if we want to be happy in retirement, if we want to don't worry, be happy, we want to have paychecks and playchecks. And paychecks are we're going to cover our basic expenses because that then covers that number one financial fear that Canadians have, which is running out of money in retirement. So we're going to get started on that in just a moment. I want to thank, as always, the sponsor, Simple Plan Community. Come on, join us there. It's a great place to share community, walk together with people who are on the same path as you, trying to do the most with the money that they've got and make just the best decisions that they possibly can. It's free to join. You can find us there at facebook.com/groups/Simple Plan Community. And we're going to mention a bunch of things toward the end of the show, including having our most recent contest winner. All right, so let's just jump right into it. Okay, we're in the wrong spot. There we go. So what is an annuity? Well, let me talk just for a moment first about the rationale behind getting those guaranteed streams of income set up. And it's twofold. One is the obvious, which is you just want to be confident you're going to have the income that you need. But the second is really more strategic and essential, and that is that we have this problem, this mathematical problem, if you will, about retirement income that's called sequence of returns or sequence of returns risk. And we are in a period where that is very much at the forefront. And I don't want to get too technical. I don't want to get into all sorts of numbers today, but I'll try to explain it a little simply, and it's this. When we retire, we are drawing down our income. And if we have mutual funds or stocks or what have you, that involves selling some units or shares of a particular investment. Now, so let's say at a given point in time, if we're going to withdraw $100 from our retirement plan, when we start out, we need to sell 100 units of our investment because they're valued at $1 each. And so to have our $100 a month income, we're selling 100 of our shares. So what happens when you get into a period like now where the stock market, the S&P 500, is down 24% since the start of the year? And perhaps going to go down more. Maybe it's going to stop there and start recovering. We don't know. So I'm going to round the numbers to make it easy for me to do the math. So that means now, instead of selling 100 shares, because my shares aren't $1 anymore, they're only 75 cents. Instead of selling 100 shares to get my $100 a month income, I have to sell 133 shares to get my $100 a month income. So now I'm eating through my investments at a much greater pace than I had planned for my retirement. And unless I have unlimited resources in my retirement fund, that means that I'm going to have a problem, because for the market to recover, those shares going down to 75 cents, if I didn't sell any of them, the market would then have to come back 33% just to be back where I started. But if I've gone and sold shares, let's say that over time, as the market was down, I sold shares so that I'm down to only 50% of the shares I once had. That now means they either have to grow by 100% to get back to where I started, or more likely I'm never going to get back where I started. And that means ultimately I'm going to run out of money sometime in retirement, unless I have an unlimited pool of retirement resources, which most people are trying to fit their income to their retirement nest egg. So here's where the problem comes in two forms. One is people actually genuinely don't have enough money to live, and so that creates a real issue for them. But the second is people have the money, but then they don't live as if they have the money because they're concerned that something's going to happen. And so they have this just-in-case attitude where they're not going to draw down their money. They're going to be very careful with it. And so rather than living in retirement, going on the vacations, enjoying the hobbies, contributing to the charities, and all those things that people look forward to in retirement, instead, they're not going to do any of those things because they want to save their money just in case. And the people who end up doing those things are their heirs, usually their children and grandchildren, who, when they receive the inheritance, will then go and spend the money on travel and hobbies and what have you. And so we want to put you in a position where you can comfortably spend that money. And the estate planning aspect is another portion. We've talked about it other times. We're not going to talk about that today. But knowing that we are going to have enough money requires that we get this stream of income going that's guaranteed and is guaranteed in several ways. First, it's guaranteed that it's going to come in. Second, it's guaranteed that it's going to keep up with inflation. And third is that it's guaranteed that it's going to last for as long as we live. And if we're married, then we want to make sure that income is secured for as long as both of us live, so that no one is left as a survivor with a big retirement income problem. Okay, so let's look at the fundamentals of what an annuity is. So an annuity, these are offered by insurance companies, insurance institutions, and they are a long-term contract, a long-term payout contract. The ones we're talking about today are a lifetime contract that provides a periodic and guaranteed income. So usually or often a monthly income, but you can set it up to be quarterly or annual, whatever you want. And then the payments are calculated based on the principal that you deposit, the life expectancy of the owner of the annuity or the recipient, the life, they're called the annuitant, the life that the annuity is based on, and the prevailing interest rates at the time. And of course, one thing that may come to your mind is that interest rates are going up. Well, and that gets talked about as a bad thing for a lot of people, and it is for people that have debt. But interest rates going up is a great thing for people that are savers. And so annuities are getting more rich right now because interest rates are going up. So essentially, you give the insurance company a pot of money. They guarantee based on whatever the pot size is and your life expectancy, which is essentially your age, and current interest rates. They say, okay, we're going to pay you X% per month. So for example, right now, a $100,000 annuity is going to generate a little over $6,000 a year, a little over $500 a month in income. Now, your quick rule of thumb will help you to know that, well, that's a 6% payout. And herein lies the beauty of it. If we talk to conventional financial planners, they'll tell you that if you have $100,000 of investments, so maybe they're stocks, a stock portfolio or mutual funds, for example, that you can, they'll say, draw 4% a year. And you can then be confident. Note, they don't say certain, they'll just say confident that you won't run out of money. Well, there's a couple of issues with that. First off, research, more recent and deeper research has shown that really it's closer to 3% that you can safely withdraw. Now, that all depends on the timing of the market. It may turn out in retrospect that you could have withdrawn more, but that's the problem. We can't plan for what happens in retrospect. We can only plan for the risks we're facing. And so 3% is the safer bet. You can go 4, but now you're getting into some more risky territory. And so at 3%, if you had $100,000, you're only going to draw down $3,000 a year. Whereas with an annuity right now, you can get 6% per year. And what we're really doing, that really encapsulates what we're doing, is we're shifting the risk. We're basically selling our risk to the insurance company. And they're going to take on the risk. We will no longer have risk, and we will receive the monthly payments for the rest of our lives. And so why does this work out? Well, we're going to look at that in a moment. Let's look at a few details of the annuity. And it doesn't matter if you can't read this on the screen. I'll just go through it for you. So the amount of the payment is established when you purchase the annuity, and it's not going to be influenced at all by any market fluctuations. It's guaranteed. Only life insurance companies do that. You can see there's one mentioned there. These are just their slides that I'm using. It's the same for all insurance companies. The benefits are that you're getting guaranteed regular income for life. It's safe from market fluctuations, as we said. It covers all your recurring expenses, right? That's the real reason we're going to do this. Now, you can do it for all your wealth, but the core thing we want to look at is making sure that our core expenses for retirement are covered so we don't have to worry about it. We also don't have to manage this in any way. We don't have to give it any thought. So for example, if you had an annuity right now, market's down 24%, is it going to go down lower? Some say yes, some say maybe not. Is it going to be affected by the upset in Ukraine? Is it going to be affected by the fact that OPEC is cutting back on oil production? Is it going to be affected by the inflation we're facing, et cetera, et cetera, et cetera? The answer is no. You just don't even have to think about it. You're just going to get those checks coming in. And so also with non-registered ones, you can actually income split the pensions or the annuities. So the guarantee period, these are kind of the features or the options of annuities. There's a guarantee period. We're looking at a life guarantee on these when we're looking at retirement. You can do what's called a joint and survivor annuity, which means if you're a married couple, for example, though it can be any two people, but conventionally it's a married couple that uses this feature. It's based on both lives. And so that means the payments are going to endure until the second person passes away, until both have passed away. You can get indexation as an option. What that means is that your annuity payments will go up with the cost of inflation. And also you can have cash refund options. So for example, if you're concerned that, well, I gave them a big lump sum of money, what if we don't even use up that money and I've died? Well, then that money can be paid out to your named beneficiaries. So you can have different guarantees in there. You can also guarantee minimum number of years that the annuity pays, whereby there would be a cash refund if you die or what have you. So you don't have to worry about the fact that you're giving up control of your money, which is what a lot of people worry about. What you're really giving up is the headache of your money, and you're giving up the concern about what may happen to your money because of market fluctuations. And a lot of people like to count their money twice, as if they can have their cake and eat it too. So let's say, well, I have this stream of income in retirement, but I also have this lump sum that I've got for a rainy day. It's like, well, it's not true, because the stream of income is coming from your lump sum. And if you actually used up your lump sum for some purpose, you would no longer have the stream of income. So this gives you the ability to fully solidify a baseline or a total stream of income for yourself in retirement. So just to kind of put some perspective on this, women, the average length of retirement for women is 28 years, and the average length of retirement for men is 26 years. Now, we define retirement as the period after which you no longer depend on income derived from employment or income derived from your day-to-day working in order to live. So retirement, you may be very active. You may be doing lots of things. Maybe you even have, an after retirement job or a side hustle or what have you, or you're volunteering. It doesn't mean you're not doing anything, but it does mean that you're not dependent on the income from your employment in order to live. So when we look at this, what's called the average length of retirement, it's not really an average. It's a fancier term called a median. And what that means is 50% of people live or are retired for less than that, and 50% of people are retired for longer than that. So in other words, that means for you, if you're a man, you have a 50% chance of having a retirement period longer than 26 years. And if you're a woman, you have a 50% chance of having a retirement period longer than 28 years. And so we were asking that question, well, why is it that if I put my $100,000 in an annuity, I can be drawing out 6% a year right now? But if I'm just doing my own portfolio, I can only safely do 3 or 4. Well, here's the secret sauce of an annuity. So your life annuity is comprised of 3 streams of revenue that you get from your annuity. The first is the interest that is earned that the insurance company develops from taking your money and investing it as they do. Now, that doesn't affect your payment. The ups and downs of that aren't your problem. That's their problem. But that's a portion of what you're receiving. That's what this black part of this chart represents. This kind of light green portion here is capital. You're just getting your money back. This would be your $100,000 coming back every year over the years. But this third darker green is something else again, and it is called mortality credits. Now, you remember we said half of people survive, half of people have a retirement shorter than 28 years for women, 26 years for men, and half have longer. So what happens for the people that don't survive as long? What happens to their money? Well, it's what's called a mortality credit. So the mortality credits go into the pool and they are shared among the people who live longer. That's how we are able to guarantee these payments for that extended period of time. So in other words, you're getting your guaranteed income for your retirement, but no matter how long your retirement lasts, you're going to get that income. And so this has 2 effects, these mortality credits. First, it increases the amount of benefit that you can receive. That's why you can get 6% rather than 3 or a risky 4. And it also ensures that those payments can go on for as long as they need to. You'll note here by the time we get to age 100 in this illustration, because this is a life annuity based on age 100, by age 100, they're living entirely on the mortality credits. So without being in a pool like this, with the insurance company called an annuity, there are no mortality credits. You cannot benefit from mortality credits. And so the interesting thing is that life insurance companies, and it's why they do this, are the ones who are perfectly positioned to do this. And here's why. If people live longer, then of course their annuities, the insurance company's annuities, are going to have to pay out more because people are living longer, more payments will be made. But insurance companies are not solely in the business of annuities. They're also in the business of life insurance. And so if people start living longer, the life insurance policies generate more and more premium before they have to pay out. So, for example, if average life expectancy goes up to age 90 from age 85 or what have you, well, insurance policies get that extra 5-year cushion. And so the insurance company is getting the benefit of the slower pace of paying out on the life insurance side, while they are having to deal with the, to them, downside of having to pay out these annuity payments longer. But they are on both sides of the equation, so it doesn't matter to their stability which way it goes, because they're on both sides of the equation. So this is why insurance companies are uniquely positioned and the only ones who offer these. And then finally, there's questions about what happens when the annuitant dies. Well, it really depends. I'm not going to go into all the details here, but let's just summarize a few. So you can have an annuity inside a registered plan, like an RSP or a locked-in a LIRA, a locked-in retirement account, or a locked-in RSP. And payments, we would often, for a married couple, go with the joint and survivor life annuity. That means that they're going to be paid. Both spouses will receive the income until both have passed away. So on the death of the first person, or let's call it the primary annuitant, the payment is going to continue. And you even have the option to select differentiated payments. So you might say, well, we want 100% while we're both alive, but if one of us dies, we only need 60% paying to the survivor. There's, again, different options there. And so that payment would continue. And then on the death of the spouse, or the second person, the payments would cease. Now, you may have a clause in there that also says that, well, if you haven't exhausted the capital portion of your annuity, that gets refunded out to your named beneficiaries, or you may have a period of time guarantee on it that says payments will continue for a minimum of 15 years, for example, in which case if both spouses pass before that 15 years is up, the payments would then continue to the named beneficiaries until the 15 years was reached. These also can work within registered plans, and so the payments that are made out of an annuity are always structured in such a way that they meet the minimum withdrawal requirements from CRA about your registered plans. And again, it can continue on for either. So this is, there are many ways that you can structure these. So that are too complicated to get into here. But the simplicity of it is it gives you the guaranteed stream of income for life at a significantly higher rate than you can generate yourself without risk. It takes all the risk off the table, so you don't have to worry. And it assures that your spouse surviving you can have that income continue, and that you are not going to run out of money no longer how long one or both of you live. And it's just that simple. Now, for some people, they like all of that security. This is definitely a more conservative type of investment, but it brings all that security, and they like that security with all their money. So for some people, they love to do this with all their money. For others, they want to just make sure that they're doing this for the core needs of their money, and they want to generate an income that's going to provide for their basic or essential income in retirement. And they're going to do other things with their other investments. And of course, for some people, they don't need to live off the income of all their wealth. And so they will do other things with other aspects of their wealth than generate income. So Just to kind of put it in simple context again, when we're looking at retirement, we want to have a steady stream of income, a guaranteed steady stream of income. We want to get the best that we can with a minimized risk. So in this case, right now we can get about 6%. That's probably going to increase because interest rates are going to go up again here at the beginning of December. That's the next interest rate announcement. Interest rates are going to go up again here in Canada, and they may go up again at the end of January. We'll see how that goes. But when interest rates go up, annuity rates go up. And we get to participate in that extra third level of wealth and income, which is the mortality credits. That beautiful bright green there on your screen. So many people are concerned about annuities. They go, well, I don't want to give up control of my money. You're not giving up control. You're gaining control, because now you're going to be certain that your retirement income is guaranteed. You have no risk to your retirement income. And you're getting that control. And by all means, you don't need to put all your wealth into this, just the portion that you're going to need to ensure that you are comfortable in retirement. And the peace of mind that people have from that is quite extraordinary. And then it frees you up to live your life as we described at the beginning. You can then go on to living with your paychecks, living within your retirement means, enjoying it, and going on to all the things that you want to do in retirement, not worrying about the just in cases. You've got other money set aside for the just in case. So that's our 2-week series on guaranteed streams of income for retirement. We looked at guaranteed lifetime withdrawal benefits or guaranteed monthly withdrawal benefits last week, which are also a great tool, and then annuities this week. So I encourage you, if you want to know more, there's different ways you can do that. Come join us in the Simple Plan community. You can also subscribe to our weekly newsletter, which you can do at go.getthesimpleplan.com/subscribe. Just slip us your email address there, and we'll make sure that's in your email inbox every week. And if you want to discuss this in greater detail, then set up a time. You can go to go.getthesimpleplan.com/calendar-new, and that is the place where you can book a time in my calendar. We can sit down for 15 minutes, just have an introductory conversation, get to know each other a little, see if there might be an opportunity that we can help you out with something, or even just answer some of your questions. There's no pressure, there's no sales pitch, there's no obligation. It's free. We're happy to do it. I love to sit down and talk to people and see where they're at and give them any ideas that might help them make their way in life financially. And just one more comment. We want to congratulate Val, who won our most recent contest, won the draw for the new book. So Val will be getting in touch with you to get that out to you. And we're going to be back with details of our next contest next week. So if you want to know what's coming up, again, subscribe to our newsletter, or you can watch our Facebook page. But if you go to go.getthesimpleplan.com/subscribe, you're going to be in the know all the time for what we're doing live and other articles and ideas that we post regularly. So thanks very much. I want to wish you and your family a happy Thanksgiving. It's Thanksgiving weekend this weekend. We have so much to be thankful for in this country. We live in a time where there's just so much animosity, and it's not necessary. So my advice to you is gather together close with those that you care most about, or those that are handy and around you if you can't be with those you care most about, and celebrate. We are a truly blessed people living in a great time with the greatest comfort and overall wealth that has ever existed on the planet. And all we really have to do is manage that wisely, and we can live a very wonderful life. So bless you. Have a great Thanksgiving weekend for you, your family, and friends. and we'll see you next week.